Hey guys, hope you and the families are doing well. In this video, I'm going to take you through a swing trade in Lyft. At the time of filming this video, I still have a long position. This is one of my favorite setups, which is a post-earnings continuation base. I'm going to be teaching you how to identify this type of trade, how to control the risk, how to mitigate the risk, how to optimize the profits. And then at the end of the video, I'll show you how you can very quickly scan for these specific setups. Market Surge are today's video sponsor. You'll see the Lyft chart in front of you. What I like about it here is triple digit earnings coming through, earnings per share estimates going into all-time high territory, and you can see the acceleration of the EPS line. If you're interested in a discounted Market Surge trial, then there is a link in the description and the comments below. Okay guys, we've got the chart of Lyft loaded up now. I appreciate a little bit busy, isn't it? There's a lot of figures, a lot of lines. Don't worry, that's all going to make sense when we start deconstructing the trade into the four main parts of a trade. What are those four main parts? Number one, we've got to identify a high quality setup. That's what we're going to be starting with. Number two, how do we control the risk to create asymmetric risk versus reward trading opportunities? That's what we'll be coming on to. I'll teach you something where you can think about the initial risk relative to the 20-day average daily range percentage. Number three is risk mitigation. I'm going to teach you active risk mitigation tactics to position yourself risk-free. So that's what I'll be explaining in the third part of the trade. And then the fourth part of the trade is how do we optimize the profits? What are the selling rules? What are the selling guidelines that we are using to optimize the profits? So let's start with the identification. So I was just speaking to you about the fundamentals. I like the fundamentals. Now I'm going to zoom out here. Now some of you may be familiar with Richard Wyckoff's price cycle or Stan Weinstein's stage analysis. They are pretty much the same things, okay? So there's phase 4 downtrends, phase 1 accumulation bases, phase 2 uptrends, phase 3 distributional tops, and so the cycle repeats, right? So if we take a look at Lyft here, okay, gets absolutely battered in the bear market for growth stocks. So phase 4 downtrend here looks absolutely terrible, right? But then what happens? Well, it starts building this large phase 1 base. Interesting. So I like big bases. I like big causes because it's the causality point. It's Richard Wyckoff's law of cause and effect. Big causes tend to lead to big effects. So big bases tend to have big uptrends in essence, and big downtrends if it's a phase 3 distributional top, right? So looking at this here, it's a big phase 1 accumulation type base. Now what's quite interesting here, okay, it's the context, okay? It's not just I'm seeing a shakeout demand tail that you're going to learn about on the 10-day MA. It's where are you seeing it? What's happened? How did the stock get there? So for me, when I'm looking at this, I'm going, okay, phase 4 downtrend, stock just gets obliterated. Phase 1, very big base here. Now it's breaking out of this phase 1 base and it's happening on the earnings, and the dollar volume on those 2 days on the earnings reaction and the day after the earnings reaction is over $3 billion if you take a rough calculation, which I'll show you in a couple of minutes. So it's breaking out of this phase 1 base on the earnings reaction. There was a surprise on the earnings reaction of 135%. Okay, large operator, maybe they're caught off guard a little bit here. The estimate was for 8 cents and the company reported 19 cents. Now there's a couple of things that the company are doing, like with DoorDash and things like that. So there's a little bit of news on it, okay? But this here, okay, potentially the market's caught off guard here a little bit. They're like, well, hang on, I wasn't expecting this. There's an earnings surprise of 135%. So not only do you get a really good earnings reaction, there's a big earnings surprise on the earnings reaction, and it's breaking out of this large phase 1 base. That's not uncommon. Okay, quite commonly you will see when these stocks start to get out of these big phase 1 bases and into phase 2 uptrends, it can be on the back of an earnings reaction, and potentially there's a surprise there as well. So we've got to have that context in mind, okay? Now when we start zooming in, what we can start looking at here from an identification standpoint, I'm actually going to just draw across this previous high, okay? So if you look at this previous high here, so this is basically the high of the phase 1 base. So the stock on the earnings reaction is powering out of that, okay? It's powering out, moving higher through that. If you take an average here, if you do 200 million shares, which is the kind of average traded 109 million there, traded 91 million there, you take an average price of those two bars of about $16.50, you get to $3.3 billion worth of stock traded. Because it's $3.3 billion worth of stock, with the juicing from this, large operators are active, okay? Large operators tend to be active around the earnings, certainly if it's in these kind of stocks as well, kind of more like momentum type stocks, bit of a story there as well, nice high ADR as well. So with the juicing that large operators are active here, what do you think they're doing on these two sessions? So this is where you're trying to link the concept of supply and demand, and you're trying to make it tangible. You're trying to make it visible, okay? You want to take the invisible and make it visible. when someone says there's a lot of buying for the stock, visually, what does it look like? Make it tangible. So this is what I call bullish synchronicity. So what you have is you have very positive price action, and it's being confirmed by the large relative volume. So if you look at this bar here, the earnings reaction, okay, so it gaps up, opens near the low of the bar and pushes up, strong close. Next session, similar, little gap up, widespread candlestick, strong close. Now large operators, they're not going to keep buying day after day after day after day and just chasing. They're not going to do that. Okay, they're just going to let the stock pull back in. So then I'm just looking for that pull back in to certain moving averages. So then what I like to do in terms of the identification, I'm looking for 3 optimal entry candlesticks. Now that is trigger bars, shakeout demand tails, and gap down reversal bars. And there's variations of candlesticks that kind of come underneath those umbrellas. Okay, I've spoken a lot, and Thomas Boswolski's work in it's the Encyclopedia of Candlestick Charts, but in the blueprint video I give you the data for what I'm actually looking for. So this is a shakeout demand tail, which is a variation of a hammer candlestick. So you get hammer candlestick, doji dragonflies to Curie lines. Okay, so this here, shakeout demand tail around 1 or more key moving averages. That's the key. So it's a shakeout demand tail around 1 or more key moving averages. So the 10 days there, the 21 is there, but it's confluence. Okay, we're looking for confluence. So not only are we breaking out of this large phase 1 base, when we pull back in and we test and we come to the 10-day, look how it's then holding the prior base highs being that pink line. So it's now holding as support. So the previous resistance is acting as support. We like that, and it's also coming down towards the lows of the earnings gap as well. There's a lot of things for this trade here. Really, really like it, okay? So now what I'm going to zoom in a little bit more and talk to you through the final part of the identification that then obviously links closely with the controlling risk. They go hand in hand, okay? So the entry for me is at $15.97. I'm targeting it through the high of this shakeout demand tail, and my initial stop loss is a cent below the low of this shakeout demand tail. Now, why is that? Well, because my reason for getting in the trade is I'm just expecting this to move back up like this. Okay, I just want to see it do that. If it starts undercutting the low of this shakeout demand tail, I'm wrong on the trade. I'm just going to get out. Okay, so the amount of risk that I'm willing to take to find out whether I'm right or wrong is this much. It's from $15.97 down to $15.38, which is 59 cents, which is 3.69%. 369 Nikola Tesla stuff going on there, right? Okay, if any of you know about the power of three numbers 369. Anyway, I digress, okay? So looking at this here, this is how much I'm willing to risk. It's 59 cents. If it starts going underneath, I'm wrong. I'll get out. Maybe it kind of pulls back down, shakes out, and does something like this and resets. But that's how much I'm willing to risk. Now, what I also think about in terms of the initial risk is I like to use this here. Now, this ADR percentage being 6.3, being 6.83%. Now, it probably would have been a little bit less, but it was around about 6% or so, okay, at this moment in time over here when I'm targeting the trade. If you want to see which indicators I use, pause the video. The ADR percentage is that one right there. If you're wondering around my relative strength line, it's this one right here. And I'm going to explain the fib retracement tool in a second, because then I'm going to talk to you about active risk mitigation. So I'm targeting the trade through the high with a buy stop limit order. I get a good fill on this one at 15.97. I attach a stop loss to that order at 15.38. So then my risk on the trade is 3.69%, which is 59 cents. Now, as the trade starts getting out here, I then have options. So as the trade starts moving out, you have options for how you want to manage it. So for me, I deconstruct it into the 4 main parts. Okay, identify, control. So as soon as I am filled on the trade, I'm into the risk mitigation. But just the final part on the controlling risk, as I forgot because my brain's going at a million miles an hour in these videos, is what I like to do is when I'm targeting an entry, whether it be a trigger bar, shakeout demand tail, gap down, reversal bar, ideally the initial stop loss is half to 2/3 the 20-day ADR percentage. However, with a shakeout demand tail and a gap down reversal bar, those candlesticks are inherently wider, so it can be closer to the 20-day ADR percentage. However, if it starts with a 4 or a 5, my initial stop loss, I've got to think it is a very, very good entry. Okay, so very, very rarely will my initial stop loss start with a 5. Very rare. Okay, where I'm trying to come in terms of initially controlling risk somewhere between 2% and 4%, just to give you kind of a feel. So this is coming in within the range, and it's very favorable relative to the 20-day ADR percentage, which I think would have been a little bit less back at this time, closer to kind of 6% or so. But it's favorable. Okay, so as soon as I'm in the trade, right, we've identified it. We've controlled the risk. We're then thinking about risk mitigation. Okay, I have open risk on the trade. I have risk of 59 cents per share. Okay, 3.69%. What I want to do is get that risk out. Okay, I want to be risk-free on the trade. Being risk-free on the trade helps create carefree states of mind. So what I'm trying to do is position myself. It's a Sun Tzu Art of War principle. Position myself beyond the possibility of defeat. I'll add to that when I think prudent to do so. So what you'll see me do quite commonly in my trading, if we now just zoom in here like this, okay, pull this across. I'm just going to delete these quarters. I've got staggered stop losses. I'll explain that in a minute. Okay, so if we just do this, okay, so what happens as the trade starts moving out? Let's do this like this. Okay, as the trade starts moving out, what I've now got an option to do here is adjust my stop loss up from where it is at 1538. I can push it up to the low of the breakout attempt bar. So because now when the stock starts breaking out, like this, okay, what I don't want to do is basically see the stock U-turn and come back around. Okay, if it starts getting out and then it starts doing this, well, there's probably a really high probability that I'd then get stopped out down here. So what I do, this is called active risk mitigation. So you see how we're flowing here through the 4 parts of a trade. Okay, identify, control, think about how you creating that asymmetric risk versus reward trading opportunity, then the risk mitigation. So what I'm then doing is I'm pushing the stop loss up invariably. So this is the active part of risk mitigation. I'm pushing it up to a cent below the low of this day here. Now, what does that do? It mitigates risk. Okay, it mitigates risk, because what I've just done is I now don't have 59 cents worth of risk. I now have 27 cents worth of risk. Why? Because my stop loss now is here at $15.70 and my entry price is $15.97. So $15.97 minus $15.70, you get to your 27 cents. So I have around about half the risk on the trade already. Okay, interesting. But what I'm doing is as the trade starts getting out, I'm pushing the stop loss up and then simultaneously selling part of the position. Now, why would I do that? Well, my free roll target is now by pushing the stop loss up from 1538, so 1538 to 1570, so lower the day by a cent. I've pushed it up, so I've now got 27 cents worth of risk. Therefore, if I have a profit of 27 cents, I can sell half of my position and I free rolled the trade. Then I'm risk-free with half of my position. Now, can it gap down the next day? Can you get slippage if it were to then come back down? Absolutely. But hypothetically here, I'm risk-free on the trade. I've removed the risk. Sun Tzu, Art of War. I position myself beyond the possibility of defeat. I'm now risk-free with half of my position. Now, if I wanted to wait a little bit longer and take a third off at 2 times the initial stop loss, a new stop loss, could have done that. Okay, it popped out quite nicely the following day. But here, as the trade starts to move out, well, I've now got to sell at a 27 cents gain because my new stop loss is at 27 cents. So if I sell half of the position at a 27 cents gain, and then I were to get knocked out at the remaining half of the position with a 27 cents stop, they just cancel each other out and break even. But for me, psychologically, getting myself to that risk-free point, okay, and then I've still got 2/3 of the position or half of the position in this interest, okay, now I can really focus on the optimizing profits. Okay, I've got the risk out and kind of carefree on the trade. Oh, yeah, whatever. If it turns around and now you turn, I'm stop break even. Who cares? There's always another bust. There's always another trade, okay? It gets you to that mindset that I think is really, really important when in the 4th part of the trade, the optimizing the profits. So that's the active risk mitigation there, okay? So that's how I then free roll the trade. So that's why you see the sale for half of the position at 16.24, okay? So what I'm now going to do is get rid of the fib tool. If you just want to set it up, by the way, you can find it over here, the fib tool. 0 is the stop loss level, 1 is the entry, 2 is at 1 times the stop loss placement, wherever that may be, 3 is at 2 times the stop loss placement, wherever that may be. Okay, so I'm just going to delete the fib tool here. Okay, so what I've now got is I've got stop staggered for quarter at 16.27 and 17.92. So something that when you're trading, okay, you want to think about optimizing profits. So for me, I'm an intermediate term trend follower. What I'm trying to do is I'm trying to get positioned in what I think are leading stocks. So those leading stocks for me are categorized into 3 main categories. Number 1 is your TMLs. These are the William O'Neill, they are the Can Slim stocks. Big earnings, big sales, big estimates, institutional sponsorship, new product, global product, those kind of stocks. That's category number 1. Category number 2 is momentum leaders. Okay, these are the stocks that have very high dollar volume and also are quick. They have high 20-day ADR percentages, and preferably they can build continuation bases, trend hard, and just absolutely fly out of them, and they can move 30, 40, 50, 100%. The third category is what I call group theme leaders. So these are stocks that are within areas of the market, it could be groups, could be themes, that are showing a lot of relative strength. Okay, so what I do is I then categorize it, and I have tier 1, tier 2, tier 3 throughout those 3 categories. Now, a stock can appear in multiple categories. Actually, Lyft for me it appears, is it a TML type stock? Yeah, kind of, probably tier 2. But is it a momentum leader type stock? It's pretty good in terms of the dollar volume, the ADR percentage. Is it a group theme leader? Actually, you're seeing a lot of relative strength in stocks like this, in Lyft, in Uber, in DoorDash. Okay, interesting what's going on here. So for me, it's a pretty high quality stock right now. So once I've then free rolled it, I'm buying much lower in the base. Okay, so how may this play out in coming weeks? Okay, this may turn out to be the bottom of a cup, and then a handle forms like this around $19-20 or something like this, and then maybe it breaks out and I can add to the position. But what I'm doing here is when I'm targeting it much lower in the base, I'm thinking about logical areas where the stock may stall out. Now oftentimes that's going to be base highs. There's going to be some trap buyers up there, and it's also going to be psychological resistance. So this overhead resistance is one from trap buyers, yes, but I actually think more so it's psychological resistance. Okay, because you have traders like me that are looking at this thinking that's probably where the stock's going to stall out, right? So how I'm then managing this one is invariably what I try and do is I try and ride the 10-day and the 21-day EMA, maybe keep some back for the 50 if I think it's appropriate for the stock. However, with Lyft, the character is such that it tends to get extended and roll over hard. So when we're thinking about the optimizing profits, you want to have kind of the data of thousands and thousands and thousands of leading stocks and how do they act. Have the data on, okay, how far do they go before they close below the 10, the 21? What do you think is best as a trailing stop? Okay, just go and look at leading stocks over the last 100 years or so, and how do they move from these continuation bases? How do they go from point A to point B? How do they go on these big runs? Okay, how are you going to optimize the profits? You want to have that data in your head, but you want to then be flexible enough to adapt to the character of the stock. Okay, if you listen to Livermore's, you read Livermore's book, you read Darvis's book, they'll talk about the character of the stock, the behavior of the stock. And it sounds a little bit weird. What do you mean the character and the behavior of the stock? Stocks act differently. They are different. They have personality traits. And the personality traits are probably created from the traders or the market operators that are trading in them, who have different character traits. We are all very, very different. We all manage trades different. So you can see that reflected in the stock. So if we go and take a look at Lyft, so what I'm doing here is, okay, I'm mindful with Lyft that, okay, I may want to be riding the 10 and 21 EMA, maybe keep some back for the 50. But then what I'm going to do is I'm going to assess the character of the stock. Okay, how can I optimize profits for this stock? Is it a really good trending stock? Does it just break out and then just trend higher, higher, higher? So higher highs, higher lows, higher highs, higher lows, and it just rides to 10, rides to 21, and it goes up 50% or something like that. Is it that type of stock, or is it not that type of stock? How does it move? Let me get a feel for this stock, okay? So when I'm looking at Lyft here, here's a really nice shakeout demand tail. Remember, I was just telling you about shakeout demand tails. Lyft seems to like a shakeout demand tail. So again, when I'm then thinking about targeting entries, I'm going back, I'm studying the stock and going, okay, how do you like to set up Lyft? I'm not dictating to the stock. I have an idea of how I want to be trading it, okay? Things that I'm going to be looking for, but I'm flexible and I will adapt. I'll go, okay, Lyft loves a shakeout demand tail. Another stock, it loves a gap down reverse bar off the 21-day EMA. Whereas Lyft, recent history is it quite likes a shakeout demand tail off the 10-day EMA. It quite likes, look at this, it quite likes a shakeout demand tail off the 10-day EMA. Isn't that interesting? But when I'm then assessing, okay, Lyft broke out from the shakeout demand tail, okay, pushed higher and then rolled over quite hard. Now here, you don't want to be emotional about this. Okay, you don't need to be emotional about anything. Okay, you just want to rationally look at this objectively and go, okay, when Lyft breaks out from this type of setup, how does it move in terms of optimizing profits? We're assessing the character of the stock, and what we're thinking here is how best can we optimize profits? So there's a couple of things that I have in my head for guidelines. 10-day EMA is a trailing stock, 21-day EMA is a trailing stock. As I said, maybe the 50, but I don't think the 50 is going to be appropriate for this stock, given what I'm about to tell you. Or when the stock starts getting extended from the 10-day EMA, see this? This is extended from the 10-day EMA, choking part or all of the position off by going lower the day, lower the day, lower the day with all or part of the position. I'm going to repeat that. So going lower the day, lower the day, lower the day, lower the day with all or part of the position as a trailing stop. So 10-day EMA, 21-day EMA, choking off, going lower the day. Now, oftentimes the way to optimize the profits is using a combination. So it might be, yeah, do you know what? Lyft here, it gets extended, rolls over hard. Now, this is only one trade. It's only one data point, but we'll go back and we'll look at a couple of others, okay? So when I'm assessing this character here, let me ask you the question, right? This is important in your trading. This is about having a game plan. Okay, you got to have a plan when you're trading these stocks. Okay, what are you thinking? There's going to come a time where you're probably going to be exiting the stock. Is there not? You may as well be optimizing the profits when you're doing it. Why would you not do that? It's entirely logical to me. So let me ask you the question. From this entry here, now granted, this is only one data point. This is only one trade that we're looking at. But let me ask you the question. If your entry is here, okay, right here, through this shakeout demand tab, let me ask you the question. What's going to be best for optimizing the profits? Is it going to be waiting for a close below the 50-day moving average? Down here. Nope, you've just given all your profits back, okay? You've literally just taken this for just a ride here. You're up 26%, you then give it all back. We've all been there and done it, right? Okay, 20, do you want to do that? Does the 50 look optimal relative to the 21? First close below the 21 is here. First close below the 10-day EMA is actually here, but you may hold because it's a green real body and it closes just underneath it. But basically the 10 and 21 are both here. They're on the same day. Okay, interesting. So what we're doing here is we're saying, well, the 10 and 21, it wasn't great. You would have given a lot of profits back there, actually, but it's better than the 50. So we're kind of chucking the 50 out right now, okay? And we're going, okay, 10 and 21, yeah, but actually, what about when the stock gets extended on that first pop, going lower the bar, lower the bar, lower the bar, lower the bar, when it starts getting extended from the 10. Now, granted, there was a little gap down there, so you then would have been stopped out there, okay? This is how we think about it in terms of the optimizing profits. We are flexible enough to look at the character of the stock. We remove our ego, okay? We're not trying to impose on the stock how the stock should move. You have zero influence. Zero influence. That should be quite humbling. You have zero influence. Certainly after you've bought, you are not Fidelity, you are not JP Morgan. You have no influence whatsoever. Okay? Remove the ego, assess how the stock moves. Then come up with a game plan. How are you going to optimize the profits? Okay, when you're in it, you've controlled it, you've mitigated the risk. What are you going to do to optimize the profits? Let's go find another one, okay? So here, if we just look at the character of the stock, so let's go and find one that's maybe actually kind of tradable. So here, okay, it kind of sets this little base in here. Okay, first close below the 10 is going to be there. 21 is going to be around about here or here. 50 is going to be here. So same purpose here, okay? Is the 50 any good? The 50 is no good, right? The 50 is no good for this stock. Okay, it's just no good. I'm not going to be using the 50 as a trading stock. Okay, the 10 and 21 are doing better here. Going lower the bar, lower the bar, lower the bar is actually going to be quite effective again to kind of choke it off into that first pop. If we go and take a look at this one here as it breaks out of this base, the first close below the 50 is going to be somewhere over here. Is the 50 any good? We've now looked at three. Is the 50 any good for this stock? No. But the 50 may be really good for Amazon or Microsoft or Nvidia or Meta or Uber or something like that, okay? You've got to assess the character of the stock. How are you going to optimize the profits? Different stocks move differently. First close below the 10-day EMA is here. First close below the 21-day EMA is here. So the gist that I'm getting here is actually if we were gonna sell half of our position, so we've got a quarter and a quarter left, or we would sell a third of our position and we've got a third and a third left. Actually, from studying the stock like this, I'm going, well, do you know what? Actually, probably kind of like choking part off, going lower the bar, lower the bar, lower the bar is going to be quite effective for part of the position here as well, right? So it kind of sets around the 50, you get this little shakeout demand tail here, right? If you went lower the bar, 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 that's going to be quite effective. First close below the 10 is there, 21 is there. So what I'd actually be more minded to do on lift here, it's probably going to be, do you know what? Choking off a part of the position, 10-day EMA for the other part of the position, maybe a little bit back for the 21 if I'm really kind of feeling it. If we go and look at lift again here, this one, it just kind of, there's kind of a little low pivot here, again kind of maybe choke it off there, but first close below here, 50 is terrible, right? You see what I mean? It's not going to be the cleanest of stocks. It's not like it just trends higher like this and it's just tickety-boo and it just rides the moving averages like this. It's not that type of stock, so you've got to be aware of that, okay? You can't impose how the stock's going to move. And if you don't like how the stock moves, if you just think, nah, this is just an absolute chop fest, I don't want to be anywhere near it, then don't trade the stock. It's that simple. It's that simple. But this is where we remove the ego, we assess, okay, how are we going to optimize the profits here? What are we going to do? So for me, when I'm then looking at it here, now hopefully this stop loss here at 17.92 makes a little bit more sense to you. Because you may have gone, well, why is your stop loss there? Because again, what have we been talking about? Choking off part, lower the bar, lower the bar, lower the bar as it starts getting extended. Okay, so not only is it kind of popping here initially, so I'm trying to sell a part into that, it's also a confluence of running into base highs, which is, as I said, going to be overhead resistance, both from trap buyers up here, people who are maybe buying it here, or held it down here and back to break even, sell, remove the pain from my portfolio, I don't want to look at it anymore, good, I'm out, break even, thank you know what for that, right? People that were chasing it up here and then they just rode it back and then oh, break even. and get out of the trade. But it's also going to be from traders like me. They're going, well, it's psychological. Yeah, running into base highs, could foresee how a cup and handle maybe forms here, but stock's likely to pull back probably to the 10-day EMA. So what I'll do here to optimize the profits on this part of the trade is I know how lift acts. Okay, it likes to kind of pop up and then roll over relatively sharply in terms of like a U shape there. So what I want to be doing is kind of protecting some profits here. Okay, raising my stop loss, lower the bar, just be choking it off there into the base high, supply shoot. Yeah, stock's kind of doing what I would expect it to do, expecting it to pull back into the 10-day EMA. Maybe it kind of pulls back in, tightens down here, then parts of the position that I've been taking off, I can then look to add back down here around, say, $17 around the 10-day EMA, or maybe the stock just falls out of bed like that. But what I'm doing right now is I'm choking off deliberately, and then I'm keeping some back for the 10-day EMA, maybe for the 21 while the stock is still basing. Because as I then have that kind of story and that imagination in my head, what chart pattern am I expecting for lift? Well, kind of a cup and handle, right? Here's the cup, pull back in, kind of shake out in the handle, start tightening. Then if it can kind of tighten here, maybe I'm looking for a spot here. Maybe it's kind of a shakeout demand tail, gap down reversal bar right there off the 10-day. Maybe it kind of puts in a really nice trigger bar there. I think the stock's going to give me some opportunities. Like I'm open-minded to how the stock wants to play out. I'm looking for opportunities. Okay, I'm looking to load up here. Okay, I'm looking to re-enter positions of what I've been selling out here. I'm looking to build the position as the stock is basing. Okay, and then just raising stop losses and using stop losses, using profits from prior entries to finance risk on future entries. So I'm then trying to increase my position size but take no additional risk and actually be backstopping in profits as well. So what I hope, guys, is that is a very kind of thorough video for deconstructing a trade and really understanding there's 4 main parts of a trade: identify, control, mitigate, and optimize. Now, what I'm going to do is I'm going to show you how you can run a preset screen on my custom built screener to quickly identify stocks like Lyft. So we're on my platform and I'm going to show you my custom built stock screener, which is specifically designed to identify stocks that are displaying a lot of relative strength, preferably have high dollar volume and have high 20-day ADR percentages. And then you can quickly identify those and then go and import them into TradingView, TC2000, MarketSmith, whatever it may be. So stock screen here is designed to be a very quick initial screener to identify those type of setups like I was just teaching you with Lyft. So this is a preset screen. If I could only run one screen, I'd run this screen. Okay, so I'm going to scroll down here. This is the US powerful uptrend with high dollar volume plus high ADR percentage. Now, if you remember, you can go and you can create your screen. You could use this as a template, build upon this. Maybe you want to bring the average dollar volume down a little bit. I've got it set at 100 million here for this screen, so looking for those much more liquid stocks in the market. If you want to look for the quicker stocks, so the ones that have high 20-day ADR percentage, you can increase this to like 3%, 3.5%, 4%, whatever it may be, right? But in our database of US stocks, we have around about 5,500. We've taken that down now to 107 results. Now, what I'm going to do, okay, you could do this by looking at relative strength on a 1 week, 1 month, 3 month basis. You could look for the highest average dollar volume stocks first. You'll see you get Nvidias, the AMDs, the Metas, SMCIs, the Broadcoms, Netflix, Coinbases, so on and so forth with the world, right? But if you want to go and look for the really quick stocks, do this 20-day ADR percentage. Let's put the quickest stocks to the top. So now what we've got is SoundHound AI, bit of a strong theme in the market right now, as the name implies. CleanSpark, which is a crypto miner. Then you'll probably be familiar with some of these other names: MicroStrategy, Coinbase up there, ARM in there, SMCI in there, right? But what I'm going to do is I'm going to go click charts, and then what we've got here, once these load up, what we've got is the black is the 10-day EMA, the blue is the 21 EMA, and the purple is the 50 SMA. So I can just be scrolling down through here. So SoundHound AI, huge move here, found a little bit of support around the 1021. Okay, bouncing. Maybe I want to have this in the watch list. So what I can do is just click this hamburger menu, put it in a watch list. I could just click here as well. So if I click this button here, it will take me straight into TradingView. CleanSpark, crypto miner, powerful move up here. Okay, basing needs a little kind of pullback into the 10-day EMA. But let me scroll down, right? I will go and show you Lyft. So Lyft is going to be on this chart. MicroStrategy looks ridiculously strong at this moment in time. So this coin bit, I was targeting it here and I didn't get filled. Shake out demand tail off the 10-day EMA, like I was telling you with Lyft. So there's Lyft right there. Okay. So here's this move on the earnings. So then what I'm trying to do is like get really dialed into. Okay, it's breaking out of this big base here. Powerful move. Look at the volume coming through. Pull back in. Shake out demand tail to the 21-day EMA, and then I could just click it there. I could go into TradingView. I could click this hamburger menu. I could go and put it into a watch list. I can then watch that watch list in your area like this. You'll have your own watch list. You can import them into TradingView, TC2000, MarketSmith, whatever you want to do. Again, Stock Screen Hero is custom built and it's designed to be a very quick initial screener to find these type of setups that in stocks that have high 20-day ADR percentages, are very liquid and displaying a lot of relative strength. That is what it's designed for. It does it very well. It does it very quickly. So if you're interested in that, you can go across to my platform. There's some free screens that you can be playing around with as well. If you really like it, you can then become a paying member if you want to. So thank you very much, guys. I appreciate all the support on the YouTube channel. Certainly if you made it all the way to this video, thank you very much indeed. And as always, I look forward to seeing you in a future video.